When you look at traders who consistently make money in the markets, it's easy to assume they know something you don't. Maybe they've mastered a strategy you've never seen. Maybe they use some advanced institutional tools. Or maybe they're born with some natural ability that the average trader doesn't have. But the real truth is far less glamorous and far more uncomfortable. Consistent profits are built on psychology, not secrets. The traders who win long-term don't win because they're smarter. They win because they're more controlled, more patient, and more emotionally disciplined than the rest. They've learned how to master themselves before trying to master the market. And that's where every profitable journey begins. Not with charts, not with indicators, but with the mind that's reading them. Most traders don't realize how deeply their emotions influence their decisions. Fear, greed, frustration, impatience, hope. These emotions don't just exist in the background. They guide the hand that clicks the button. Think about how many trades you've taken, not because they were part of your plan, but because you were bored and wanted action. Think about the times you entered too early because you didn't want to miss the move, or held onto a losing position because you didn't want to admit you were wrong. These aren't trading mistakes. These are emotional reactions disguised as decisions. The market doesn't punish you for not knowing enough. It punishes you for not controlling yourself enough. Consistency begins with patience, the ability to wait for your setup, to wait for your confirmation, and to wait for your edge to appear instead of chasing the market. The hardest part of trading is doing nothing, and yet doing nothing is often the most profitable thing you can do. The market is a constant stream of noise, movement, temptation, and illusion. It's designed to make you feel like something is happening at every second. But professionals don't react to noise. They sit, they observe, they analyze, and they wait. They know that the market pays those who are selective, not those who are active. Every trade you take without patience is a trade you take without probability. But patience isn't just about waiting to enter. It's also about waiting to exit. A lot of traders think they lack discipline when entering trades, but the real breakdown usually happens during the trade, not before it. The moment you're in a position, your mind shifts. Your expectations shift. Your fear increases. Your confidence fluctuates with every tick. This is why most traders take profits too early, not because the setup has changed, but because they can't handle the psychological pressure of watching unrealized gains fluctuate. They watch a green position, feel good for a moment, and then feel the fear of losing that green. So they lock in a tiny win, only to watch the market run in the exact direction they expected. This isn't poor strategy, it's poor emotional management. On the opposite side, there's the stubbornness that keeps traders in losing trades far longer than they should. A losing trade doesn't feel like a financial loss. It feels like a personal failure. Closing it means accepting that you were wrong, and for many traders, that's harder than losing money. So they hold and they hope. They tell themselves the market might reverse, or that it's not a real loss until they close it. But in reality, losses only grow, and hope doesn't change market direction. Successful traders understand that losses aren't personal. They're business expenses, necessary, expected, and manageable. They accept them quickly because they know protecting capital is far more important than protecting ego. Another part of the hidden psychology behind consistent profits is emotional neutrality. The best traders don't get overly excited about wins, and they don't get emotionally crushed by losses. They treat both outcomes the same way. When you become overly excited after a win, you become reckless. You start believing you're in the zone or on a streak, and suddenly you're taking trades you would normally avoid. Success tricks you into overconfidence. On the other hand, when you get emotionally hurt by losses, you fall into revenge trading, hesitation, or fear-based decisions. Losses trick you into self-doubt. But the traders who excel are the ones who stay neutral. Calm after a win, calm after a loss. Calm in uncertainty, calm in opportunity. This neutrality keeps them consistent. Consistency also requires reducing the noise around you. Most traders are overwhelmed with information. Twitter predictions, Discord signals, YouTube strategies, Reddit theories, indicators stacked on top of indicators. The more information you consume, the more confused and reactive you become. Your mind jumps from one idea to another, never building true conviction. But profitable traders simplify. They know exactly what they're looking for and ignore everything else. They don't need flashing signals or complicated systems. They focus on price, structure, context, and risk. This clarity makes psychological discipline easier because decisions become straightforward. The psychology of consistent profits also involves understanding that the market doesn't owe you anything. Many traders enter each day expecting a win, expecting movement, expecting action. But the market doesn't exist to fulfill your expectations. Sometimes the best trade is no trade. Sometimes the right decision is to walk away. Professionals have no emotional attachment to the day. If there's no opportunity, they don't trade. Retail traders struggle because they force the market to give them money, and the market responds by taking it. Consistent traders respond to what the market is actually doing, not what they wish it would do. Risk management is psychological before it's mathematical. You can write rules, set stop losses, and create position sizing tables. But none of that matters if you override your rules the moment your emotions spike. Most traders don't blow accounts because of one huge loss. They blow accounts because of a long chain of small emotional decisions. Slightly increasing position size, slightly moving the stop, slightly breaking a rule, slightly chasing a move, slightly hoping instead of acting. These tiny emotional lapses accumulate until the account collapses. But consistent traders remain strict. They don't adjust rules mid-trade. They don't rationalize bad behavior. They treat discipline as a non-negotiable requirement, not a suggestion. One more psychological factor that impacts consistency is identity. If you think of yourself as a gambler, you'll trade like one. If you think of yourself as someone who is trying to get lucky, the market will treat you accordingly. But when you begin to think of yourself as a professional, someone who follows rules, someone who stays disciplined, someone who treats trading like a business, your decisions naturally shift. Your identity shapes your behavior. The mindset you carry into the market influences the outcome you experience. The path to consistent profits is not about eliminating emotions. It's about understanding them, anticipating them, and managing them. It's about building mental habits that keep you stable regardless of what the market does. It's about learning to remain patient when your mind wants to rush, calm when your mind wants to panic, rational when your mind wants to react. Consistency doesn't begin in the account. It begins in the mind that controls the account. Once your psychology matures, your results follow. If this message helped you understand trading psychology at a deeper level, make sure you hit the like button so more traders can benefit from this video. Subscribe to the channel for more deep, straight-to-the-point insights just like this, and drop a comment to let me know your thoughts. I'd love to hear what part connected with you the most. And if anyone wants to support me financially, you can mention it in the comments as well. Thank you for listening, and I'll see you in the next video.